Welcome to Equity Mates Investing, the podcast where we explore what's possible in the world of investing. If you've joined us for the first time, welcome. My name is Bryce, and today we're kicking off with some market headlines and Nvidia's earnings. We're launching a brand new segment called Pimp My Portfolio, and we're bringing back Book Club, discussing the Millionaire's Factory. To chat through it all, as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce, and I'm excited for this episode, but I'm sad for you.
Why's that?
Because they say in life, don't meet your heroes.
Yeah,
because it
haven't met many of
can
them.
only lead to heartbreak. And you not only had the chance to meet your hero, but for a few years you worked for your hero. And no, I'm not talking about me. I'm talking about your former boss at Woolworths, Brad Banducci. Now, last week on the podcast, there was a question in the Equity Mates Facebook discussion group about what you thought of the ABC interview. And maybe less than 24 hours after we record that episode, your hero falls on his sword.
If you're wondering why Ren is like pumping this guy up and my relationship with him, yes, I did work at Woolworths for a moment of time.
Don't downplay it.
I'm not. I do still have a lot of respect for Brad Banducci.
Yeah.
He was an incredible...
one of the best CEOs in the world, I think, has been bandied around.
Don't say what I say behind closed doors. Yeah, look, it was sad. It was shocking, the news.
So for people who don't watch business news as closely as us, he quit.
He resigned.
Yeah.
Yes, he put in his resignation on Wednesday, the Wednesday after the Four Corners report on ABC that was pretty damning into, alleged price gouging from both the major retailers. Reading between the lines, still knowing a few people at Woolworths and the commentary that's coming from Woolworths, it was just bad timing in terms of the announcement of the resignation. He had planned to resign this year anyway. He's been leading the company for, I think, about 8 years, and they already had a successor in place ready to rock and roll. So you could say poor timing. From a public perception point of view, and what is getting raked over the coals at the moment is he's just rage quit. So unfortunate for him to end this way, because in my view, he was an incredible leader to work underneath.
Yeah.
So I have a lot of respect for him still. If you're listening, Brad, I think I've asked you 10 times to come onto the show. Please, we'd love to have you on when the dust settles.
Yeah, it would be great. And everyone's saying it's terrible for his legacy, blah blah blah. That was being bandied around the office yesterday, and then I asked the question: name the Woolworths CEO before him. Like, corporate CEOs, unless you're like Steve Jobs or Jamie Dimon, you don't have a legacy. People forget you. Like,
arguably, Brad's will have much more of a legacy than the CEO before him. Let's put it that way.
I thought you were about to say Jamie Dimon or Steve Jobs.
No.
All right, well, let's get into what's making news in markets, I guess aside from the Woolworths news. And really front and center has been Nvidia's earnings. Before we talk about some of these company results and what we are watching, we've got to remind everyone...
This is not financial advice.
That's right. Any information on this show is for education and entertainment purposes. Any advice is general. And Ren, I'm now finding myself humming this at home.
Oh, really?
Yeah, and Harriet's like, what the hell are you singing? Wait till we drop the not financial advice caps that are coming.
True.
Hats, I should say.
The stings are... The stings are doing so well that they're getting their own merch.
Yes.
All right. Well, let's talk semiconductors. Let's start with Nvidia, but then I've been looking at the semiconductor world beyond Nvidia, and I want to close it out with my best way to invest in the sector.
Okay.
And it's not Nvidia.
And it's not the ETF.
It is not.
No.
But let's start with Nvidia, because it seemed like the whole investing world was waiting. I saw CNBC had a countdown, like a New Year's Eve style countdown, and it was like 21 hours, 50 minutes, 49 seconds report.
Yeah.
Like, come on. So what did we learn?
Well, they've shot the lights out again.
Again.
Like, we've learnt that, as we said last week, trends in investing continue a lot longer than you expect. So hit us with some of the numbers.
Well, I think for context, between 2022 and 2023, Nvidia's revenue was flat, $27 billion in both years. So it's not like this. They're on like a long hockey stick growth up. Like it's been an incredible story for a number of years, but flat revenue, and then this 2023, the hockey stick inverted. They went from 27 billion to 60 billion in revenue. So they more than doubled their revenue in a year. So that's up 126%. Quarterly, so just looking at the last 3 months, they made revenue of 22.1 billion, up 22% from the 3 months before that. But amazingly, up 265% from the same time last year. Now, when we spoke to Kieran Moore from Munro for the summer series, he spoke about Nvidia, and he said the key part of their thesis and why they thought Nvidia had more growth was data centers.
Yeah.
That was the Nvidia break out their revenue, and the data center line was the line that they were watching. So with Kieran's, I guess, thesis ringing in my ears, I had a look at Nvidia's data center revenue. How is this for the quarter? 18.4 billion in revenue, up 27% from the quarter before, but up 409% from the same time last year. Kieran Moore's probably rubbing his hands.
We should have given. Maybe next week we'll give him a call, or I will get him.
Mate, he wouldn't
maybe
answer
on
his
Instagram.
phone. He's out there celebrating.
Yeah, true.
Nah, so obviously an incredible result from Nvidia. I think the really important thing as investors is that expectations were sky high for this stock. And so if you were buying Nvidia today, it wasn't so much about how the company's going, but it's more about what the expectations were already built into the price. Because investors were expecting a massive result. From what I've read so far, these numbers surpassed expectations.
Yeah, well, the after hours stock movement also suggests that. I think it jumped about 8% a few hours after market close. So we'll see what happens when the market opens again overnight, but definitely beating expectation.
Yeah. Now, semiconductors are obviously front of mind because of AI and Nvidia.
Yeah.
But I wanted to have a little bit of a conversation around semiconductors beyond Nvidia, because Nvidia isn't the only stock making moves in the space. The best performing US stock above $1 billion in value this year is a semiconductor stock. It's not Nvidia. It's Supermicro.
All right.
Have you heard of it?
No.
I hadn't really either. Up 177% year to date.
Year to date.
Yeah, year to date.
What?
Yeah, I know. It's one of the largest producers of high performance and high efficiency servers. It has manufacturing operations in the Netherlands, Silicon Valley, and Taiwan. So, no idea about the company. As I said, hadn't heard about it, but worth having it on your radar because whatever it's doing, it's shooting the lights out this year. But it's
Founded in 1993. Imagine the story of if the founder still owns this and is involved in this company. For 20 years, I don't know how it's performed actually over the last 20 years. This is a big over exaggeration here, but could just be like plodding along, doing well. But in the last 2 years, your business has just gone nuts.
Well, Bryce, let me tell you about another company that was founded in 1993, Nvidia.
Well, there you go.
That's when it was founded, and it was doing like GPUs for gaming. And it was seen as a gaming stock. Like it did very well.
Oh man, no doubt.
And I'm sure this one as well.
But they've just like woken up one day and gone, "Oh my god,
I'm a multi-billionaire."
I'm a billionaire. Yeah.
Another one that has performed really well in this space is ARM.
Yep. IPO'd last year.
Yeah.
Another semiconductor maker. 80%
more for mobiles.
Yeah.
Power a lot of the mobile operating system, the mobile hardware around the world. Bit of a short squeeze from memory.
Yeah, well, they're up 80% year to date.
Yeah, I think their float isn't massive. There's a lot of people short it, and they're getting squeezed a little bit. But just another story of like why you would short this sector at this point in time.
Yeah.
But I think the craziest story in the semiconductor space is Sam Altman, the CEO and co-founder of OpenAI, the makers of ChatGPT and DALL-E and now Sora. He has a side hustle, a little side project that he's working on to reshape the global semiconductor business. He is apparently asking for between $5 and $7 trillion. That is not a typo.
Trillion.
Well, that is how much he thinks he's going to need to do what he wants to do. And so people are speculating about what he wants to do. It probably will involve... So to build a foundry, like a semiconductor, a place where you make semiconductors, it's about $30 billion. So maybe he wants to massively increase the number of foundries out there. There's also speculation that the number of data centers that are going to be needed and their energy requirements is just going to be astronomical to power the AI revolution. And so maybe it's something in that space. But yeah, apparently he's asked the UAE Investment Corporation to start tipping in some money.
7 trillion.
To put 7 trillion in perspective, that is 14 times larger than the global semiconductor industry, which did 527 billion in sales last year. It's 5 times all corporate debt issued in the US last year, 1.44 trillion. It is equivalent to the value of Apple, Alphabet, and Microsoft combined. It's more than the GDP of all countries on Earth, aside from China and the US. Put another way, it's equivalent to the combined GDP of India and the UK, or 1/3 the GDP of the US. So, Bryce, my question for you, do you reckon he's going to be able to raise it?
Imagine the pitch deck you'd need for $7 trillion. I mean, if there's a guy that could do it and understands where all this is heading, it's Sam Altman. So, how this plays out, with the whole board issues that we saw last year with ChatGPT and whatnot, I don't know if this is a side project. It seems like a massive side project. So, interested to see who tips money into this.
Yeah. Now, and for context, like China's invested about 150 billion in their domestic semiconductor manufacturing efforts and hasn't really made a dent globally. So, if Sam Altman's ambition is to reshape the global semiconductor industry, he'll need to invest more than China already has.
Yeah.
Now, I said I was going to close out with my best way to play this semiconductor theme.
Yeah.
ASML, I still think, is the best way to play it. For people unfamiliar, they're the only maker of advanced lithography machines that are critical in the production of semiconductors. I think, there's so many people designing semiconductors. Obviously, TSMC and Samsung are making a lot of them. But ASML are a real bottleneck, a real monopoly in that supply chain. And so whatever happens around them, they're going to be critical.
Yeah, that's a good shot.
So I haven't looked at the financials or what they're trading at recently, but I think if you're interested in this space, if you're getting caught up in the hype, a company to add to your watch list is the Dutch lithography company ASML.
All right, well, welcome back to Equity Mates. We're very excited for this. It's the first ever Pimp My Portfolio, so let's get started.
This is Pimp My Portfolio. Pimp My Portfolio.
Yes. Firstly, welcome to Corey, the first Equity Mates community member to submit his portfolio and join us on the show. Corey, welcome.
Ahoy, gentlemen.
What did you think of our opener?
Yeah, we're big into stings this year.
Yeah, no, it's it fits the tone, so definitely.
Good.
Nice.
So
now for people who are hearing this Pimp My Portfolio for the first time, this is a new segment we're kicking off this year where we are getting experts in the studio to have a look at the portfolios of the Equity Mates community and give some general advice on what they are seeing, what they think. They might ask some probing questions about what they're discovering in there. But it's a chance for us all to have a professional cast an eye over what we've been buying.
Yes, so joining us in the studio, we have Luke Larrative from Seneca. Luke, welcome.
Bryce, Alec, how are you?
Luke, we're good. We're excited. We're pumped for this segment.
Yes.
No, it should be good.
Yeah.
Looking forward to it.
Yeah, now Luke is going to be the expert going through this. A word of warning, as always, that this is general advice only. And
we should be clear in this context, Luke doesn't know Corey from Adam. Like, he does know nothing about Corey's personal circumstances. All we've got is the list of holdings and portfolio weightings.
So yeah, I don't know anything about Corey's personal circumstances, and obviously that's probably the most important thing about giving advice to people is you need not just general advice, but advice to a person, which is why, I'm an advisor and I believe in the value of advice. But hopefully we can provide some general sort of thoughts and
some
strategies.
Yes.
Yeah, some ideas for Corey to go away with and for us all to reflect on. But Corey, massive thank you for sharing your portfolio. Now, we're going to start by, I guess, explaining what we're seeing. And then Luke has got some thoughts, and he's got a nickname for it as well. So Bryce,
Everyone's going to get a nickname.
So Bryce, tell us what is in Corey's portfolio.
All right. So, Corey, I'm seeing in your portfolio there are a couple of ETFs, one that tracks the NASDAQ, and then there are a couple of thematic in cybersecurity, robotics, and semiconductors, as well as uranium. And then there are a bunch of individual stocks, mostly listed here in Australia. Some include Aussie Broadband, HitIQ, Weebit Nano, and Qantas. So an interesting range there.
Yeah, the split is about 42% in the ETFs and then about 58% in the individual stocks. So with that said, Luke, kick us off.
All right, Corey, thanks for doing this, mate. This is what I've called the all punt, no process portfolio.
How do you respond to that, Corey?
Not sure yet,
Sorry, mate. I'm trying to be,
but
funny.
it kind of works, I guess.
So just to be clear here, all punt, no process is what you've called Corey's portfolio. So give us a bit of a reasoning why that is.
Yeah, look, I think we're going to find a little bit about how Corey's actually bought these stocks and come to doing that in a minute. But it's just a disparate mix of stuff that's kind of weighted a little bit strangely from my perspective. And, there's definitely, I can see some ideas that he's trying to sort of, capture in the way that he's investing. But by the same token, not necessarily doing that in a way where it's going to have impact for him. And then kind of like, running off and I like that stock and I like that stock, and then putting kind of the wrong amount of money in those kind of ideas for the quality of those kind of ideas, if that makes sense.
Yeah. Awesome. All right. Well, a bit to unpack there, but let's start with the process.
Yeah. So I'll start with the stocks because that's probably the easiest bit. So we've got, a lot of story stocks in here, Corey, and, what I'd call story stocks, Weebit Nano, HitIQ. Tell us a little bit about kind of how you've chosen those stocks and, why you like them so much.
Yeah, so there's a couple of stocks in there that would be driven by certainly listening to other podcasts like Equity Mates or Equity Mates itself. Yeah, those two are the ones certainly that are there. But I think out of all the stocks, none of the others were based on any of that. They were all decisions I made. Mm-hmm. In terms of the heavier weighted ones, I guess particularly in those, I tend to go heavier on stocks that are cheaper, just due to I try and put $500 to $1,000 in either stock that I invest in. As a general rule.
When you say cheaper, what do you mean by cheaper? Like the price, the ticker price?
Like I get, a cheaper price. Yeah, so an average cheaper price. But because I'm starting out as well, I understand the dollar averaging. I'm trialing different products, but Weebit was probably something that, because I work in IT, I read into it a fair bit, and I believe that there has to be some change in that type of memory, especially with, that's why I'm also in semiconductors and robotics with the AI trend.
Yep.
I think it goes hand in hand with that. HitIQ is probably, that definitely matches that all punt no process one, I guess. Definitely. That would probably be more one that I heard on the Equity Mates podcast, and I looked into a bit more and believe the same thing.
I'm shaking my head, Corey, at the two boys. I've got giving them a stern talking to after this.
Yeah. But that was, again, I didn't just buy it. I did look into it, and I think I bought that recently when they made an announcement that I agreed with, particularly in this case about the AFL. So that's why I've put into that.
All right. So
I think the business has the room to grow, and I think it's something that, in terms of, like, for instance, with the AFL, what you see in professional sport, yes, will usually go filter down to your more community sport and that. So that's
understand. Know the business, like, understand it. I just suppose it's good just to get a flavour for where you're going. Like, I've sort of looked at this stuff on the basis you've been holding these stocks for 12 months at least. Are they some of these new purchases, or
everything on there would have been in the last 5 to 6 months max? I only started in late August. I think Aussie Broadband might have been the first one.
Yeah, and
then obviously just growing from there, a mix of ETFs as to try and balance that, and then other individuals as well. I think I do have one on US stock market. I dipped into that because I find a way to learn is to, I guess, kick the drop punt, as you are trying to nickname, and just see where it goes. And that's the only way I learned by trial.
I'm a big believer in that. Big believer in that.
Yeah.
So Corey,
as much as you can read on, you have to take the dip. So
yeah, mate, for sure. Look, let me give you some stuff I think that you can think about that's sort of a little bit more actionable. So with your uranium exposure that you've got there, you're paying 69 basis points for that particular product, and then they take 15% of your money and hand it to another, essentially ETF provider in Sprott, who charges you a further 72%. Only 3 of the top 10 holdings of that particular ETF have outperformed the physical underlying uranium, which is that Sprott trust that they buy. And you can go and buy that Sprott trust yourself. So if you're just looking to get exposure to the uranium sector, more broadly, and uranium prices more broadly, the way to sort of avoid that, what we'd call non-systematic risk, the risk that is associated with each individual company, you can kind of avoid all that, pay less fees, and kind of still do pretty well and still play that uranium theme. So I think that's something you could definitely consider or think about. If you want to own the stocks and you like Cameco and the Kazakhstani Uranium Co and all that kind of stuff, fine, I get it. And maybe that's not the right thing for what you want to do, but that was just something that stood out to me. If I'm going to play the gold sector or I'm going to play the uranium sector, I'm always looking for sort of pure play commodity, because it's a macro thing I'm trying to play, not the micro thing at the companies. If I like Cameco for whatever reason, which might include a positive thesis on uranium and something about their mine process or the corporate play or whatever, I'll buy the stock. But I don't really see the point in owning the diversified stocks, if that makes sense. Either do the work on the companies and get down to the nitty gritty and own whatever, or just buy the physical. Does that make sense?
No, it does. And with the uranium in particular, I was on 50-50 on that. I think I was looking into, I think it was Yellowcake and Boss Energy, obviously. And when I was you have that look and you go, I don't know which one to invest in, and you have to really dig deep. I saw the ETF as, we'll use that as a way to cover them all.
Yeah.
Well, I think the 3 that I looked at were in the top 3 or top 5 holdings at the time of that ETF. So that was kind of where I looked at it from that point.
Yeah. Anyway, look, just something to consider. It doesn't have to be, it's not must be one way, must be the other. It's just, some thoughts for you, I suppose. The other thing I think you need to have a look at is overall portfolio construction. So, if you're going to buy diversified ETFs, whether they're sector ETFs or, broad-based market, geographic type ETFs, that's where you want to put the bulk of your money, particularly when you're getting started out investing, I think. You want to be in diversified things. You want to benefit from, people starting companies in aggregate and trying to grow them, make more profit every year and kind of betting on human capital going up, for lack of a better word. And then, put the smaller weights in the stuff that you want to have a punt with. And you want to, you need to do some work on your own. If you were going to run a high conviction stock portfolio, you'll be running kind of up to 10% maybe in a single company. But if you were trying to do some sort of core satellite, you might be sort of 5 to 10% in companies, and then maybe 80% of the money in some more core sort of type stuff. I would treat the sector ETFs like non-core as well, as kind of like a stock, if you know what I mean, and then try and get some more broad-based exposure to markets more broadly.
So, Luke, on that, are there any particular names or funds that you think are good ones to start your research on if you're looking for broad-based market exposure? Yeah,
I think if you're looking for broad-based global equities, you can obviously choose any of the sort of BlackRock, Vanguard type stuff that do MSCI All World benchmarked, or you could, put together a basic thing, or just buy the high growth, sort of multi-asset stuff. But there's lots of good active managers as well. Whether it's, a GQG we use in our model at the moment, who do a sort of broad-based global equities portfolio, or someone who has a high conviction portfolio like a Stephen Arnold at Aorus, who's a really good manager and, really good at what he does too. So who's also in our global equity portfolio.
So Luke, just to close out here, Corey, your portfolio reminds me somewhat of my portfolio when I first started, which was no punt, no process, kind of similar to how I run it at the moment as well. But
Bryce will be on next week.
Bryce,
that's not true.
Bryce says that, but he's the guy that puts 80% of his money into like market tracking.
Well, this was
index
my point.
ETFs.
Yeah. So Corey here has a couple of stocks that are very overweight compared to other positions in the portfolio.
Mm-hmm.
And so generally speaking, going from here to kind of rectify the portfolio construction, what the general advice is to start building up the positions in the more broader exposure ETF.
Yeah, sort of. Look, I'm not big on these slow transitions.
Okay.
Right. I the beauty of being in listed markets and not buy, if you go and buy a warehouse or you do something else with your money, you don't have the option just to switch and change and buy next door's warehouse instead of yours. And whereas here you can, you can exit every single one of these positions and buy, whatever you want, perfect portfolio for you today. So my view is figure out what your perfect portfolio is, and then the second thing is buy it. And then you have got your portfolio that's set, and you're investing every day how you would ideally for the future from that point forward. So that's kind of my view is there is really no hold in investing. There's only sell. I don't want to own this investment anymore, or rebuy at today's market prices. If you own a stock ABC, it's trading at $1 tomorrow it goes to $2. Well, your decision not to sell is just a decision to rebuy that stock, sort of X of tax, at $2 again today, because your alternative is to sell it. So there is really no hold. It's a continual decision to rebuy these stocks at today's prices or to sell.
Nice. Well, Corey, that sort of brings us to the end of our first Pimp My Portfolio. A couple of decisions there, I guess, for you to think about, which is, A, specifically around the uranium exposure, but B, thinking about how you are going to re-weight some of the exposure that you have there with Aussie Broadband, HitIQ, and Weebit Nano, and re-weight some of that back into the more diversified ETFs and then go from there. So certainly hope that Luke has been able to provide a bit of general advice there for you. And thank you so much for being the first cab off the rank. If you
Appreciate
do
that,
update,
Corey.
very, very much appreciate it. Hope you got something out of that.
Yeah, there's a couple of points there, and like you touched on the point of you either sell or rebuy. I've already done that a couple of times, and that's like, for instance, Aussie Broadband, which is heavily weighted. I've done that twice already.
Good man.
So that's probably why it's a little bit. But yeah, there's a couple of tactics there and such that I'm already looking at or can take on board and know that I'm in the right direction there at least, or look more into it.
Nice one.
Thank you for that.
Well, I mean, you're only a few months into your investing journey, and it is really a lifelong journey. So a massive congratulations for getting started and for withstanding Luke's barrage.
I got to get better at this. I will improve.
But hopefully it's giving you some thoughts on where you can go next on the journey, and good luck with it.
Worries. Appreciate it, guys.
Easy. Thanks, Corey.
Thanks, Corey.
Appreciate it. Now, if you would like Luke to review your portfolio, you can book a time with him. He'll have a look at it, discuss broader markets with you, or help with your financial goals. Head to equitymates.com/advice and select Luke's name in the contact form, and we'll make sure that you go straight through to be able to book an appointment with Luke at Seneca. But Luke, thank you.
Pleasure, gentlemen.
All right, we're going to take a very quick break, and then on the other side, we're bringing back another segment for 2024, and that is Book Club. Welcome back to Equity Mates Investing. Just like we've got new stings this year, Ren, we're bringing back segments that we're dusting off from the early years of Equity Mates. So let's hit it.
Book Club. Ren's reading the book, so Bryce doesn't have to.
Yes, that sting
Slight
is...
sledge here, but that's all right.
That sting is acknowledging, I guess, the reality that killed Book Club last time around.
What was that?
You stopped reading the books. I still remember it. It was the
Yes.
J.D. Rockefeller book.
Yeah.
You chose it.
I chose it.
And it was this big, thick monster. And
700 pages.
I read it all through summer. Get back in the studio after summer. You haven't read it.
So funny. So at least we're true to ourselves in acknowledging what this segment will be. Look, there will be times where where I'll bring a book in, and in fact, today's book
Yeah,
I've read some of.
Yeah.
Not
Yeah,
knowing that this would be a book club segment. But you've read the full book. So firstly, before we kick off, if you have a book you'd like us to read, or you want to come and tell us about a business or any sort of biography or whatever it may be that you're reading, somewhat related to money and markets.
It's gonna be a quite broad book club this year, I think.
Great. Well, there you go.
It'll all be non-fiction, but I think it all counts as investors.
Yeah, great.
Like
Let us know. equitymates.com/contact. But Ren, today we've got the Millionaire's Factory.
Yes.
The inside look at Macquarie Bank.
Yeah, a fascinating look at the Millionaire's Factory, as it is known. Macquarie Bank, for people unfamiliar, they started as an investment bank. They started as an Australian arm of a London investment bank, and then really have just expanded beyond that. They are now massive players in infrastructure, big players in funds management. They have a retail banking arm here in Australia, and have fingers in so many different pies, like infrastructure in the broadest definition of infrastructure, like data centers and energy and everything.
Yeah.
It's a fascinating company, and it is a fascinating story because it's quite a unique culture and I guess growth story.
I think the cultural part, from what I have read, is the biggest one of the biggest takeaways from this, and we even know from the experiences we've had of meeting ex-Macquarie employees and also just understanding how they operate at the moment, like the way that they develop culture and a culture of high performance and rewarding high performance so that, you know, your best people stay around. And also, I guess, keeping everything as internal as possible. You look at the leaders of the bank, and I think they've had four or five.
They've had 6 CEOs, all of them from
the
internal.
bank. So they've worked their way up through the ranks.
But it's not even that. They have this exco, which is like the executive committee below the CEO. And it's very rare for anyone to be hired directly into the exco. Like, there was one guy who was brought in from Westpac to really drive their retail banking strategy. And that was so unusual that he was straight into the exco. So it's like they're very much like a bottom-up, hire from within organization.
Well, you're also rewarded by staying there.
Yeah, 10-year vesting period on your shares,
yeah.
and if you quit, you lose that.
Yeah, well, it's like, for example, their highest earner, I can't remember his name.
Nick O'Kane.
Nick O'Kane, who essentially quit.
Yeah.
He would be leaving a lot on the table.
Yeah, so that context is really interesting. So he was known as like their big earner, their big deal maker. He really made his bones. Macquarie have a massive energy trading business, and he... along with some of his colleagues, really drove that growth, like post-GFC. And he came back to Australia, and he was seen as a potential successor to Shamara. And when he came back to Australia, that was seen as the next step in the succession plan. Yeah. And so, you know, I was reading about that, and then you flick on the news and he's quit, and it's like, oh, that's interesting. Something has obviously changed there. Anyway, I've got 5 key takeaways, so I don't want to dilly-dally too much. And I think these are takeaways that are somewhat applicable to Macquarie, but I think they were good general investing takeaways.
Okay.
So the first one, Macquarie has grown by its theory of adjacencies. And so that is where they start in a business and they're just constantly looking for the next angle to make more money or to the next opportunity adjacent to where they are or where they have expertise. And this is best illustrated in their infrastructure growth. So they started just as a corporate advisor on deals, but then adjacency after adjacency they found and they exploited to the point where, and not as much anymore, they're a bit more arm's length in some of this, but at one point they were earning fees on advising the seller of an infrastructure asset, arranging the financing, underwriting that financing, and then the management fee on the fund that buys the asset, performance fee on that fund as well, and then fees on selling the asset. So they were involved in like every part of the transaction.
That's good business.
Peter Costello, the former Australian treasurer, he had a quote that I pulled out. Quote, "I never found Macquarie argued after the event. It was, these are the rules of the game. We exploited them to the full. If you want to change the rules, we'll abide by whatever the new rules are." And you knew that they would exploit the new rules to the fullest as well. And it's just like, that was Macquarie, just like get in industry,
Yeah.
figure out where the opportunity is, and just
Go for it.
find that next little
Yeah.
way to exploit it. And if the rules change, then they change what they did. But that is the growth story of Macquarie in the US, in Europe, in Canada, in Australia, in all these different arms. It's just really smart people being given license to go. And that really leads me to my second takeaway, which was a real bottom-up culture at Macquarie. And it really had hallmarks of Sam Walton's Made in America, is that what it's called?
Yeah,
the
Made in
Walmart
America, yeah.
CEO, where he was so focused on devolving power from head office to his stores, giving his stores, treating them like business owners, the store managers like business owners, essentially giving them P&L responsibility for that store. That's the same as Macquarie. Like, these smart people are given responsibility to build businesses. Essentially, Macquarie will pay for your desk in a lot of these like new markets or new industries, and then you got to do it yourself.
You do it, yeah.
And like a lot of times you fail, and that's okay. There was a story in here about Nicholas Moore before he was CEO holding a big seminar about all the failures at Macquarie and like celebrating all these people that had tried things and failed things. And like that was the culture. Give things a crack. If you have an idea, it's like things aren't top down. It's not like here's what we're gonna do. Risk management is top down.
Yeah.
But the ideas and the growth are bottom up. So that's the second one that I thought was really interesting. Third one, risk management. Really strong risk management gives the ability to be counter-cyclical investors. So Macquarie famously haven't blown themselves up like so many other big peers have, big investment banks have, and they've really taken advantage of opportunities to invest through the cycle. So after the 1987 crash and the subsequent recession, they bought Security Pacific Australia. After the Russian financial crisis, they bought BT. After the GFC, they bought Constellation Energy in Houston. Like these periods where a lot of their peers were like risk off, batten down the hatches, let's go through these financial shocks. Macquarie was out there and buying things, which I think then...
Which isn't so much risk on, it's just they have a risk management framework
that allows
them
to
make those
Well,
decisions.
I mean, it allows them to take risk when no one else is.
Yeah.
It allows them to take advantage of undervalued assets, which I think is a good lesson for us as we look for investments, what companies are managing risk well and being sensible about risk and not getting caught up in the cycle. But it also is a lesson for us as personal investors. Let's not get too caught up. Let's make sure we've got powder dry so we can invest when everyone else is not investing.
Running away.
i.e. 2023.
Yeah.
So that's 3 takeaways. 2 to go. My fourth one, even the best investments have bad times. And you see this time and time again with like the great stocks over a long period of time, you know, like the Monster Energies or the Domino's Pizzas or the Games Workshop over in London. Like these absolute star performers have had massive periods of underperformance where everyone fell out of love with them and their share price fell. Macquarie is no different. Between September 2001 and August 2002, share price fell from $41 to $25 in about a year. That was around the time they bought Sydney Airport and then tried to privatize Qantas, and they tried to do a whole bunch of stuff, and people fell out of love with them. Richard Branson very publicly was attacking them. Fascinating stories, worth reading the book. But that fall had nothing compared to their fall during the GFC. They fell 80% in like a year and a half.
I remember I was at high school, GFC hit, I think it was year 9 or 10. Well, yeah, it would have been around then. And there was this guy in my class, Fabian, and he just kept saying, buy Macquarie, buy Macquarie, buy Macquarie. And I'm like, what is this guy talking about? And he just absolutely nailed it.
Well, yeah, if you'd bought Macquarie at the depths of the GFC when they were like 19, 20 bucks, you would have almost 10 bagged it.
Yeah.
So shout out to Fabian wherever you are. If only Bryce listened to you.
What a legend.
And then my final takeaway to bring it home, this company just purely relies on brilliant people.
Yeah.
And for me, that's risky. It just, as I was reading this book, the Warren Buffett quote just kept ringing in my ears. We look for businesses even a fool could run because one day one will. And it's like, if a fool ran this business...
Gone.
Yeah. Like if the risk management framework is off, if they don't see something coming around the corner, if whatever it is.
It's a good point.
Yeah, like it is a business, and all of these exploiting opportunities, like time after time in this book, it's a story of like an individual person being empowered, but then doing what a lot of their peers couldn't do, like convincing American state governments to privatize infrastructure, or convincing Canadian pension funds to back this little known Australian bank. It's like
I guess they just back themselves to keep producing.
Well, I mean, your thesis
quality talent.
around Macquarie has to be like they get the pick of the talent here in Australia and globally, and then they have an incredibly strong training program, and like they.
Yeah.
But that's risky.
Yeah, of course.
It's not like if you ask Macquarie what their moat is, you'd say, oh, they've got like the entrenched advantages in a lot of markets, and they've got brilliant people. But yeah, it's not like I don't know. I'm trying to think.
It requires a lot of human input.
Put it this way, to go full circle on this episode, it's not like Woolworths where there's like a really clear moat in like this massive store network and, great positions and, all the stuff that you need to, like a fool could run Woolworths and not do a great job, but not blow it up.
Yeah.
If a fool ran Macquarie, they could blow it up.
Yeah.
So that's a risk.
Nice. Well, that's the first episode of Book Club for 2024. It's written by two guys from the AFR from memory.
Yeah.
Is that right? Two journos? Yeah. So that was The Millionaire's Factory, an inside look into Macquarie Bank. I think that's the byline, or an inside story of how Macquarie Bank became a global giant. So check it out. If you'd like us to review a book, or if you'd like Ren to review a book and me to pseudo read it, hit us up, equitymates.com/contact. Also, you can leave us a question there. You can submit a portfolio for Pimp My Portfolio. We can connect you with some financial advisors if you're looking for professional help as well. So hit us up at equitymates.com/contact. Well, Ren, as always, it's a pleasure to chat stocks. And tomorrow, Adam Keeley will be back for Buy or Sell.
Yes, back by popular demand. So look out for that. We'll be back in your feed on Thursday. So speak soon.